Hello, everyone. Today on the Final Bar, it's Monday, January 30th. We'll talk about this market setting up in a position of weakness going into the Fed meeting tomorrow and Wednesday. Lots of earnings to unpack as well. Ladies and gentlemen, this is the Final Bar. Hey, everyone. Welcome to the Final Bar on this Monday. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and cold Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The technical toolkit that our website is built around is designed to help you navigate the markets in uncertain times by focusing on the message the market provides back to us in the form of price and breadth and sentiment. Also momentum, and momentum may be a concept we revisit a number of times today. You have stocks that have had really good runs off of the October lows, names like Tesla and others that have had some bright moments along the way, but a lot of those giving some of the gains back here recently. You have a lot of the FAANG stocks reporting earnings over the next couple of days, most of them, if not all of them, pulling back today. Some of them like NVIDIA, Tesla, others having some pretty painful days today. Now, that's not giving back a ton of the gains, but giving back a little bit, and certainly having a bit of a different feel than we saw last week, which is the market sort of pushing higher through the course of the week. Friday's close was pretty much weak going into the weekend. Continued weakness through the course of the day with the S&P continuing to push down ever onward and ever downward, I guess. We're going to start here with our market recap. Let's check in on what happened through the course of the trading day today. So we're starting here with the S&P 500. Look at Friday, right? We had the push to the upside, which was continuing the upside momentum through most of last week, right? Fairly strong week, giving the impression that there was going to be this beautiful bullish setup going into this week. S&P pushing toward 4,100. Today, for what it's worth, kind of getting the opposite feel, right? It's following through in the last 30 minutes of Friday. Today opened lower, and then the S&P continued to push downwards. So the S&P closing just below 40.18. That's down 1.3% from Friday's close. The NASDAQ composite was down about 2%, so leading the way downwards. And I mentioned some of those FAANG sectors like technology, communication services at the bottom of the list so far today. Mid caps and small caps all down just over 1%. Only green on this first page is the VIX, which actually bounced back to the upside. Now, that was one of the key themes we've talked about through last week. I remember my guest, Katie Stockton, last week or the week before, we were talking about low volatility and the fact that the VIX had ranged from around 20 on the lower end, 30, 35 on the upper end through the course of 2022. We're now at the lower end of that. Does that mean that we are setting up for rising volatility and falling markets? That's not what we've seen, obviously, so far in 2023. We've seen the market push higher and volatility come back down. Today, a bit of mean reversion there. And I think mean reversion is probably the way I would describe this day until we gather more evidence suggesting it's anything other than that, right? And so I tend to think of things in terms of the primary trend, like the main direction, which I would argue now in the short term, still positive, even though today was a bit of a give back. And that's how we would describe it, sort of a give back, a pullback within that uptrend until we start to break down, right? Until we start to show further signs of weakness that tell you this is not just a fluke sort of day, but something building downside momentum. What's so interesting about the fact that this happened today is the Fed meeting starts tomorrow. We get all the details on Wednesday, and we'll have to see again how we unpack the market activity between now and then. We also have a bunch of earnings, to be honest with you. After we talk through some of the main sort of macro indicators, we'll look at some individual stocks on the move as well. Interest rates overall moving higher today. You have 10-year yield getting up to 3.55. That's up from just above 3.5% on Friday's close. Bonds, of course, in terms of prices moving lower, and the dollar index up by about 1/3% using the UUP ETF. Commodities, for the most part, lower. Natural gas down quite a bit with the UNG down about 7%. Crude oil prices down as well. Also, gold and silver, not a big negative day, but certainly not showing any renewed strength. A lot of red on the pictures of cryptocurrencies as well, and that's an interesting one. Bitcoin pushing up toward 24,000 over the weekend, which would be a high watermark for sort of this recent, couple months, bouncing off of the lows in the mid 15,000s, pushing higher through the weekend. today sort of rolling over. And as equities went sort of risk off mode, you saw a risk off move in cryptocurrencies as well. The 10 major coins which we track here down anywhere from 2 to 7%, with Bitcoin and Ethereum both down around 4 or 5%. Bitcoin back below 23,000, Ether down below 1,600 through the course of the day today. Let's look at a chart of the S&P 500 here. Then we'll talk about some of the other sort of macro themes, and then get into sectors and stocks as well. So when we look at this perspective, I was writing my premium note for my premium members at Market Misbehavior for Saturday morning. And we spent a good amount of time, as we usually do, with the chart of the S&P 500. And just one of the things that I would point out is we've seen so many bullish tells that have played out in the last couple months, right? And that goes from, starting probably with the bullish divergence that you saw for the S&P 500, a number of other things, the new low September into October, the higher lows in momentum. Looking back, look at that great bottoming signal, suggesting that the downtrend was most likely near an exhaustion point. From there, we've moved higher. And then what was interesting is we had this period here in November and December where we were testing the 200-day, testing a trend line and failing to eclipse both of those. 4,100 was where we stalled out. Now we've gone back up, and on this second sort of set of attempts to get them, or maybe the third attempt, if the first one was in August, second one in November, December, third one here, and you can see we've actually completed that break above those levels. So the 200-day clearly broke into the upside. This trend line using the 2022 highs also broke into the upside. As we talked about last week, and as I shared with my premium members, now you have like one more sort of key thing to do, maybe two, would be getting above 4,100, which would be completed. Once you get above there, like there's nothing left really to sort of say, if we could only do X, Y, Z, then it's going to be a bullish market. Like I think at that point, you just have to accept complete bullishness. Now I think it's, for the most part, very bullish when you think of price and breadth, but not quite in terms of the ultimate follow through, right? So today, instead of powering through 4,100 going to the Fed meeting, we're actually pulling back a little bit. We'll have to see how tomorrow plays out, and then into Wednesday to see, start to make some assumptions about what may happen around the Fed meeting. The RSI went from being above 60 to back below there, and so the RSI stalling out at 60 is what usually happens when you have a big bear market rally and then you fail to follow through to the upside. So very much again just providing yet another question mark in terms of the overall trend. But if you ask me, is the weight of the evidence more in the bullish or bearish camp? I would have to say bullish, given the strength that we've seen off the lows, the higher low in December, and the break above the resistance levels as we talked about. The breadth conditions being so strong, I think, is part of that too. Now, we could very much go lower. We could absolutely retest the December low. We could retest the October low. We could even go down to 3,200. And I would say I would very much not be surprised if that ends up being the ultimate low that we've not seen yet. But first things first, at this point, we're sort of in a range again, right? And 4,100 at the upper end, we'll call 3,800 on the lower end. And we may sort of back and fill within this range for a little bit. That's another scenario. So at this point, a break above 4,100, very bullish, and completing that bullish rotation, which we talked about, which opens the way, I think, to 4,300 plus. Or we trade back to the lower end of this range, in which case 3,800 becomes an incredibly important level once again, which it has been for 8+ months as we first identified that level coming off of the high in early 2022. Let's go back to the dashboard. Just talk quickly about sectors. As I mentioned, I didn't mention actually very much a defensive feel today when you think about the price action, but also in terms of the sector movements, right? The things at the top of the list, fairly defensive. Consumer staples, arguably one of the more defensive of any, most defensive. The only one of the 11 S&P Spider ETFs positive for the day, and just by not much. Utilities, number two, still down about just 0.4%. Financials, the third, down 0.5%. The big underperformers today were energy, down over 2%, technology, almost 2%, consumer discretionary and communication services. So you have risk off from some of these energy names that have had pretty good runs, charts like Marathon Oil, DVN, all in the bottom 10 list for the S&P 500, but also a lot of FAANG stocks, right? NVIDIA, which technically not a FAANG stock, but it's in the group of names. I call them the Nomina 8 stocks, one of the 10 worst performers today. And if you're wondering why our benchmarks are down so much today, I would show you this list of 8 stocks, and the FAANG Plus index is listed here as well. But look at these names, and you can see Amazon down 1.7%, down to NVIDIA down 6%. When these big mega cap FAANG stocks are down that much, the benchmarks have no chance. Even if everything else was up, I think the benchmarks would still be down a little bit, probably. That's an exaggeration, but you get the idea. Huge impact. Now, a number of these, half of these are reporting earnings in the next couple days, right? Meta is Wednesday after the close. Amazon, Apple, Alphabet are all Thursday after the close. So not only do we have the Fed meeting on Wednesday to digest, Tuesday into Wednesday, we also have a bunch of earnings. And those are just the FAANG stocks, a bunch of other ones. ExxonMobil tomorrow, UPS tomorrow, Merck, ConocoPhillips, and many, many others are in the next couple days. So worth paying attention, obviously, to some of those names. And when you think about it, when I think about a chart like Apple, right? We'll dig into just briefly here. Think about how the S&P has gotten above its 200-day moving average. Think about some of these other stocks that we've talked about having incredible runs and giving back a little bit today. Compare that to the chart of Apple, where if you take a step back from your monitor, I still see this as more of a downtrend phase, right? Because we've not really broken to a new swing high. We haven't even made a higher low. While the S&P was making a higher low in December, Apple's actually making a new low for the year, right? It's actually started 2023 at the lowest point it had been for the last 52 weeks. So some of these big mega cap names have not recovered to the degree that we've seen elsewhere. The strong breadth conditions don't speak to the breadth in a chart like Apple, which is still trading below a downward sloping moving averages. I've quoted one of my mentors a number of times recently talking about how nothing good happens below the 200-day moving average. And let's remember that that is where some of these names remain. Just to finish off here, we'll look at the chart of Bitcoin. I mentioned cryptocurrencies struggling a little bit. This time is starting to look a little bit different in terms of the acceleration of Bitcoin off of the lows, looking back to some of these previous bear market rallies that we saw through the course of the last 12 months. The Bitcoin becoming overbought for the first time since October of 2021 is pretty meaningful, right? And that speaks to more of a broader rotation. I have this big red line indicating that breakout level. Can we remain above there? That would be my big question mark. Today, with the pullback that we saw in Bitcoin actually out of that overbought region. Now here's the warning and the potential retest. Can we hold that breakout level? That's what I'd be looking for on the chart of Bitcoin. Let's take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is your host, Dave Keller. Pleasure to have you join us every weekday after the close. Couple quick announcements before we continue on with today's show. Number one, we're going to do a mailbag segment a little later in today's show. We'll do another mailbag at the end of this week. We're doing them a couple times a week, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Drop a comment below the video you're watching on our Stock Charts YouTube channel. Hope to answer one of your questions live on the air in our next mailbag segment. You can go to our StockChartsTV.com on-demand platform on your on the website or on your mobile device. All the great content that we feature, conversations and highlights on this show, and all the other contributors show. People like Joe Rabel, Julius DeKempener, Tom Bowley, Greg Schnell, T.G. Watkins, providing some fantastic commentary and expertise every week and every single trading day. You can find all of that for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Upcoming schedule, you may notice a bit of a different look to the show today. We're also broadcasting at 6 p.m. Eastern, same situation tomorrow. That's because we're doing a bunch of testing in our StockCharts TV studio. We've spent a lot of time and resources getting our studio up and running. We were at the toward the finish line. We're getting very, very close, doing some final testing, incorporating the last technology, and making sure things are all running very, very well. We hope to be back or in the TV, in our StockCharts TV studio here very soon. If you watched ChartCon last fall, you saw a preview of what that studio capabilities are, and we're excited to bring it to this show. So coming soon, we'll be back live at 4 p.m. this Wednesday. Sam Stovall of CFRA Research is going to be our guest. That'll be on Fed Day. We'll have the Fed meeting results a little bit earlier, and then we'll sit down with Sam and look at the charts and talk with him about an overall outlook related to the Fed's announcements. Also, Dave Landry will be joining us on the show on Thursday the 2nd. We'll probably look at some of these companies reporting earnings this week, maybe a little bit of crypto as well. Let's continue on our show today with the Final Bar mailbag. Keep the questions coming, and let's get to question number one. Dave, now that the S&P is above 4,000, is it time to declare the bear market over? I love that question. I wanted to address this, and you mentioned a number of things, right? Indexes have been rising nonstop since the beginning of January, 100% true. Seems like inflation is cooling down. That's what the indications appear to be telling you. Does the technical analysis suggest that a new bull market is on its way? So I wanted to make a couple comments on your question itself, right? So number one, you have to remember, separate the bear market, but bear versus bull market call with something like inflation, right? When you think about inflation, the data on inflation is not a great leading indicator for the stock market. It's actually the reverse. The stock market is one of the best leading indicators for economic activity. So you actually should be looking at the stock market to predict what's happening with inflation, because investors tend to do a pretty good job of pricing in what's going to be happening down the road. So inflation data probably cooling down, the market will probably recover, and then the inflation data would actually start to get a lot better. Usually is kind of how it happens. So anytime I hear people quoting economic data as a justification for declaring a bull bear market, I have to remind you, think about the market evidence first. The economic evidence is always a lagging indicator. Now, having said that, what does that move in inflation? Does that suggest that the Fed is going to do something different? I think that is one of the big questions to be answered here. By the end of this week, we will have had half of the FAANG stocks, or phenomena stocks, as I call them, having reported, some big market cap represented there, along with a bunch of other energy companies, consumer names, and healthcare, and so much more. So I think we're going to have a lot of questions answered in terms of how these companies are pricing in. A lot of these are companies that have been making cuts in employees and resources, and what does that mean for their outlook going forward? I think that's where the implications of inflationary pressures and how these companies are budgeting for those going forward, I think, could be a lot more clear. Also, in terms of the Fed, right? And it's not just the Fed's 25 basis point cut, which seems most likely, but it's also the language that we get. I think the Q&A after with Chairman Powell will be very important to see whether that happens. So those are all sort of big picture things. You know, what does the chart tell us about that? And I hope I've made that pretty clear, right? And I would say, in general, I tend to avoid labels like bull and bear markets, because I think you can get into trouble if you base things off of that label. Having said that, what does the price action imply, and what does it tell you? For me, as I've mentioned, I think breaking above these resistance levels that we faced was huge, and I'm inclined to lean more bullish than bearish. And I would say that the path of least resistance appears higher in terms of the price action. What makes me nervous is all the macro headwinds that I mentioned. I would argue that the implication of what the Fed is going to be doing and the implications of higher inflation, I feel like those are still headwinds going forward. So we have a tailwind of a strong market. Don't fight the tape says we're going higher. We have headwinds with the Fed, and I think don't fight the Fed says we might be going lower. So again, I think through the course of this week, maybe we'll have some of those questions answered. That's a great question I will certainly pose to my guest, Sam Stovall, on Wednesday. Next question. You mentioned that position sizing should be based on volatility. Can you give an example of how that is done? Yeah, so I can't get into too much details, but I will tell you this, right? When you're looking at a particular stock, when you have something like United Healthcare, right? Think about what the average movement is in a stock like United Healthcare. And you can make just a basic evaluation by looking at the price movements and the percentage change on a particular stock, or you can actually bring up average true range, which we have as an indicator on StockCharts on the Sharp Charts platform, but also on ACP. And if you look at the average true range, this is basically saying for a 14-day look back, what's the average movement in this stock in dollar terms. And average true range means the true range, high versus low, but it's adjusted for gaps. So if you have a gap down, you actually adjust to the previous day's close to basically close that gap. So these big gaps are included in the calculation of the average true range. If you look at 10 different stocks, you will see their average true ranges tend to be very different. And that's why a $1 move in a stock like United Healthcare means something very different than a $1 move in a penny stock, right? Where $1 would be this obscene exponential rise. You also have to think about the fact that the volatility is very different. That's another angle to think about, right? A stock like United Healthcare tends to have a certain degree of historical volatility, meaning how much the stock tends to fluctuate, similar to average true range. Something like a utility name, which is pretty low volatility, tends to not move so much, all of these indicators looking at range, daily volatility or historical volatility are going to be much, much lower just because it's a much lower moving name. So if you have $100 in a portfolio and you have 5 stocks and you allocate $2 to each position, your utility name is going to be a non-factor because it's not going to move much from your original $2 position. Your biotech small cap stock is going to fluctuate a ton. And all of a sudden, your entire portfolio's return are basically just the biotech stock. It's nothing to do with Southern or whatever that low volatility name is, right? So by equal weighting or dollar weighting a portfolio, you are artificially gearing way too much towards those big volatility names, which means you basically want to put a lower position on the huge volatility names and a bigger position on the lower volatility names, which means an equal move in each stock has an equal impact on your portfolio. That's how you actually weight the portfolio to be even for each of the ideas that you might have been looking at. I hope that makes sense. And if not, I'll look for some other resources. And if I can find a good idea, a good article that explains in a little more detail, I would do it. But it would basically be basing your position on average true range, historical volatility, or some measurement of how much the stock actually tends to move, and weighting more volatile things a little less so that it doesn't completely rupture your portfolio if there's a big move. Next question, what is the difference between MACD and PPO? And it's funny, I refer to the PPO very often. My market trend model is driven off of the PPO indicator. It's a combination of exponential moving averages. You actually included this article that my friend Art Hill wrote over 10 years ago now, which basically, what is the difference between MACD and PPO? I would encourage you guys to read that. And if you don't know where it is, click on the magnifying glass and just type what's the difference, or MACD and the PPO, and you'll get to this article. If you look at our blog space for the articles, it's a brief little description that explains the difference between the two. And he really hits on the difference, which is it's an absolute measurement or it's a percentage measurement. And I have this chart of Apple showing both the MACD and PPO indicators. So let me add add to what Art put in that article to explain what this difference is. The MACD indicator stands for Moving Average Convergence Divergence, and is a very popular indicator based on moving averages. So here we're looking at the 50 and 200-day simple moving averages, and often people do what's called a crossover technique, right? Which is the short-term moving average crosses up or down through the long-term moving average, and those are your signals. Simple moving averages have some issues, and one of them is a 200-day simple moving average weights the last 200 closes exactly the same. So what happened yesterday and what happened 182 days ago have the exact same weighting. Seems a little weird. An exponential moving average or other things like a weighted moving average adjust for that by weighting certain data stronger than others. And exponential averages are way more sensitive to the most recent movement. So exponential moving averages tend to be more widely used in trend following trading systems because it's a better measurement of trend reversals. And that's why my market trend model is built on exponential averages. You take the 12-day and 26-day exponential moving averages, the 12 minus the 26-day, and that's what that black line is, called the MACD line. The red line is a signal line, which is a 9-day moving average of the MACD line. And that's the crossover technique you look at are these two. The PPO, as you can see, looks almost identical, and it is. The only difference is it has an additional component, which it does that difference, the 12-day minus the 26-day, but divides that difference by the value of the 26-day moving average. So it's basically what percent above or below the 12-day is versus the 26-day moving average. It looks about the same, and the only difference you would see is if you look at a much longer time frame. So now I'm looking at 10 years of daily data, and you can see as we go back, the MACD becomes less and less helpful because the price levels were much lower for Apple back here on an adjusted basis. So as a result, it's hard to really see the differences there versus the volatility that you can see in the indicator here. The PPO adjusts for that because it's based on the percentage moves, which tend to be a lot more consistent. So if you are looking at a number of different stocks, if you're looking at one stock over multiple timeframes, the PPO is a better indicator because it's based on percentages as opposed to absolute values. And those absolute values will change when a stock has a big move or when an index has a big move. That's why the indicators are different. In terms of their signals, they're almost identical. In terms of the interpretation, almost identical. The PPO is just a little more superior, I found, because of those reasons that I shared. We need to wrap the show, folks, and go to the 3 in 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I was looking at the S&P 500, this question on average true range, maybe dig a little bit earlier today into the S&P. And I just wanted to show you this chart with the one-day rate of change. So this is simply showing you the one-day percent change in the S&P 500 overall. So the S&P was down 1.3% today. That's why this indicator is at negative 1.3. This rate of change or ROC indicator is a really great way of just looking at percentage moves over time. Look at a 5-day or a 10-day or a 20-day look back, and you can get some interesting color in terms of how much this thing is changing over that look back period. But a one-day rate of change is just showing you every day's percent change moves. And I just want to show you the moves, the price swings that we had in the S&P 500 in 2022 and so far in 2023 versus the percent moves that we saw in 2021. This is sort of a low volatility, slow and steady uptrend. Look at how the average movement was pretty low, right? We occasionally had days over 1% higher or lower, but that was incredibly rare. On average, the days were much closer to about 0.5% up or down. Compare that to 2022, where it had these huge swings, right? And the biggest percent changes that you see over this 2-year period were not in the bullish phase of 2021. They were in the bearish phase, right? The biggest gainer that we had, over 5%, was in this move off of the October lows, which is still in a bearish cyclical market. So when people talk about the downtrend of a secular bear market, a cyclical bear market that is, in 2022, you have to remember that the biggest down days and also the biggest up days tend to be during the bear market phases. So it's not like bull markets see a bunch of big up days. It tends to be lower volatility and lower movements because it's an accumulation phase. Distribution phases have big up days and big down days. Chart number 2 is real estate. REITs actually had a decent day today, not at the top of the list. That was consumer staples, but real estate tends to be a pretty constructive sector in defensive tapes. But what's interesting is if you look since late October, the real estate sector has actually been outperforming. Now, this is an area of the market where you tend to have a little higher yield. So if you're concerned about uncertainty, concerned about instability, something like REITs actually play a decent dividend, and we've had capital appreciation as well. So if you don't have any exposure to real estate, might be an interesting time to see, because this is actually a group that's performing well, despite the fact that the market's going higher. It's not just for defense. Finally, I wanted to share the chart of RIVN. I was driving around the area here in Redmond, Washington over the weekend. I'm seeing more and more RIVNs pop around, and we have a strategic stockpile of Teslas because SpaceX and others have big offices here. So there's a lot of Teslas flying around. Not as many RIVNs, but I'm seeing more and more, and it led me to think about the stock price a little more. This stock has been in a consistent downtrend. What's interesting to me is the stock was oversold from mid-December to early January, now coming out of that oversold region. I'm not a big fan of this chart yet because I'm not a big fan of bottom fishing. I would much rather wait until there's signs of improvement. But overall, it's undeniable that this chart has been down. My question for you on this stock that's down another 9% today, at what point would you feel confident buying a chart like RIVN? Is it when we are making new lows? Is it before there's a rotation? Is it after we confirm a breakout? Look at this chart and think about that. That might help you think about buy and sell decisions going forward. That's a wrap for the show, folks. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, be safe. We'll see you next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.